stablecoin markets will be 5 trillion plus. And I think a lot of those holders are international. They're in Vietnam and Nigeria and Lebanon and Turkey and Brazil and India, places where people want dollars and they can't easily get dollars. And so what happens when that $5 trillion is looking for yield?
GM, good morning. Welcome to the Milk Road Show, the daily crypto show that's like a group project in college. Runs on one person doing all the work while everyone else stakes the rewards. I'm your host, Jay Hamilton. It's Monday, September 22nd. Myself and the Milk Road team are currently on our annual retreat in Croatia. We're cooking so we can all dominate the upcoming bull run. So this conversation was recorded last week on Tuesday, September 16th. Today, we're joined by Avichal Garg, co-founder of Electric Capital, a leading crypto-native venture firm managing billions in AUM. He's also an early investors in projects like Near, DYDX, Bitwise, and more. And prior to crypto, he worked at Google and sold a company to Facebook. Today, we're going to discuss Bitcoin had its institutional moment in 2019, 2020. Is 2025 the year that ETH finally gets its turn? We all understand that Bitcoin is on its way to becoming a leading store of value asset alongside gold, but what about Ethereum and other crypto tokens? How many store of value assets can there really be in crypto in the long run? And finally, what happens when 1% of money market cash moves into ETH-backed paper? I'm talking about DeFi. I'll tell you, it's going to be a tidal wave. We're going to break all this down with Avichal. Now, before we jump in, if you guys are doing swaps, which I'm sure you are, as you're setting up your portfolio for the next leg of the bull run, make sure you check out Milk Road Swap. Why? Because we built it to give ourselves a place to swap so we could have a cheap place to do our trades. So check it out at swap.milkroad.com. Today's episode is brought to you by Figure Markets. Grow your cash like a bank, no lockups, just for returns. It's also brought to you by Nexo, the platform that grows your capital without locking it away. With that, Avichal, welcome back to the show.
Good to see you.
Great to see you too, my man. Let's jump right in. You've talked recently in your role and with your hat on of your participation in ETHZilla and that digital asset treasury company. You've talked about there was a moment and a shift that happened recently when Bitcoin and ETH really became accepted as collateral by big credit funds. You consider this high quality liquid collateral. What does this mean, and what's the impact of this moment?
Yeah, so maybe starting at a really high level, these digital asset treasury companies, I think, are a really interesting phenomenon, and they sort of blew up in the last couple of months in terms of just the volume of them existing. And I think there's based on what we see, there's still a huge pipeline coming. This all started with MicroStrategy, and I think Michael Saylor very correctly realizing that what he had was in Bitcoin an asset that could go up 30 or 40% a year. And he could borrow money at 7, 10, 12, 14% a year, depending on the terms. When you put that together, you say, wait a second, if the credit markets are willing to lend me money, in his case, because he had an operating business to start and he was able to sort of prove out the strategy. But if the business can borrow money and I can go borrow at 10% and buy a thing that goes up 30 or 40% a year, that's like a money glitch, right? I should just do that all day, every day, and just, lather, rinse, repeat. And so he started doing this and amassed, $50 billion of Bitcoin. The company's worth $100 billion now. It's a remarkable thing that he pulled off. And other people looked at this and said, wait a second, if you can do it for Bitcoin, could you do it for other things? Now this opens up a whole can of worms, as you could imagine, which assets and how much do they go up and what are the drawdowns in a bear market? And there's a whole sort of set of questions that emerge here. But kind of fundamentally, I think the thing that he noted or figured out in the capital markets, and I think he is a capital markets genius as evidenced by sort of all these structured products he's built on top of MicroStrategy. What he noted was the willingness for the capital markets to lend to go do this sort of behavior. And so, I think that connection of the world's capital markets to flow them into crypto is a pretty clever innovation. And I think if you look at each crypto cycle, that's usually what happens. Like somebody invents a new product, and that product gives you access to a new part of the capital market somewhere, and then that capital market gets tapped and all that money kind of flows in. And I think that's kind of what's happening here with these DATs. It's a capital market innovation to let capital flow into crypto in a new way.
So I think we all know the story of MicroStrategy, and it's far enough in its existence and its story. I mean, its existence, it existed as an operating company well before, but its existence as a digital asset treasury and doing that playbook for us all to trust it and believe in it. Ethereum's new as a digital asset. What changed? Why Ethereum now? What is allowing Ethereum to have this type of, all these questions that you said, can Ethereum have run that same playbook as a different asset, which has different volatility and different
Yeah.
ups and downs in bull and bear markets?
Well, there's an argument that actually more volatility is better, right? A lot of what drives the activity around these vehicles is the ability to have options markets and volatility traders around it. So actually, more volatility could be better. And ETH is more volatile right now than Bitcoin. There are a couple of different market participants here. I think there are sort of the vol traders, they're the credit guys that want to lend into this, and then there's the people that want to buy these assets, and have access to the shares directly. And in some sense, the volatility and the credit guys enable this, but the downstream effect, if done well, which is a big asterisk, but if done well, is actually you can have retail get a really good product, right? You could actually, because the ETFs can't stake, at least not yet. I think a lot of people
Not
think,
much.
yeah, a lot of people think, I think the SEC will allow for this, relatively quickly, like potentially in the next couple of weeks. But
But will they allow like 100% staking, or won't it
excellent
still
question.
be 50% likely?
Yeah, I mean, you have to manage the liquidity because you have to get, you have to destroy the shares and buy or sell the ETH. And so depending on your inflows and your outflows, you do have a liquidity problem. Like I'm not deep enough on the ETF structures. You should have Hunter from Bitwise come on, but my understanding is that what that would mean downstream is you wouldn't be able to use 100% of the assets for staking. And even if you did use 100% of the assets, you could end up in tricky situations where, let's say, 100% of the assets are staked, and then you have these OTC transactions you could do to say, hey, look, I'll sell you my staked ETH, because the exit queue on ETH is 50 days right now, or whatever it is. And so then you might have to eat a bunch of slippage, right? And so, like, on the way out, you might have transaction fees on this, that the ETF has to eat somehow, pass through, which could make it an inefficient structure relative to what ETFs typically are. So I mean, even an ETF that has 20 bips of fees or 30 bips of fees, like the Bitwise ones I think are generally lower cost. But it could be a material part of the fee structure of these things to get in and out of these things every day. You're just eating the slippage. So you look at it from that perspective, and you're like, well, actually, a thing that can 100% stake the ETH, and in the case of ETHZilla, where we're the asset managers on the back end, the thing that we're working with, we've already started to do, is you can start to do all these other things in DeFi, especially with Ethereum, which don't even exist on the Bitcoin side. And so we announced, for example, a partnership with EtherFi, and deployed assets from ETHZilla ETH into EtherFi, to the tune of about $100 million. And so Ethereum DATs and potentially Solana DATs, Kyle from Multicoin, they're running a big one on the Solana side. And some of the other ETH ones have talked about this. And so, that starts to be compelling, because what you might be able to do is, let's say base staking yield on the ETH side is something like 2% right now. I can't make forward statements, but I think the potential for these entities to significantly outperform staking is what makes this now compelling, right? So now not only do you have like the fundamental ETH exposure as an end holder of these shares, but you're getting some exposure to the DeFi ecosystems as well, which is outsized yield. And so all of a sudden, if you could, in theory, make double the yield of staking, like, why would you hold an ETF? Would really be the thought, right? Or why would you hold the underlying? It's yeah, I could stake it on Coinbase, but maybe what I just want to do is hold it in my 401k account and get double or triple the staking yield. That starts to look really compelling, I think, from like an end user perspective. So I think there's an argument that if well managed, these entities are actually quite good for retail. But there's a lot of sort of ifs layered in there, right? There are a lot of things that could go wrong there too.
Well, that's what you're saying, if well managed, because you and I both know that some will be well managed and some won't. And the outcome of that will, when we can talk about the risks of that later in the episode, if we get to it. I don't want to dive too deep into that. We've talked about it a bunch in recent episodes. I want to touch on Solana. We've been talking so much about Ethereum on the show recently. The big credit funds, they seem to be moving into Bitcoin and Ethereum. Are they moving into Solana and other crypto tokens?
They're starting to. So the big credit funds actually are not that deep yet into the crypto-backed lending and this whole universe. In general, you see this kind of with the investment banks as well. So like take somebody like Citi, right? Like a proper GSIB, like a big bank. They've done a small handful of these DATs. If you look at the smaller investment banks, Cantor, Cohen, Clear Street, these guys are doing real volume. Like, they're the ones that are actually driving this. And you see this in a lot of markets, right? Like the upstarts and the new entrants find this wedge and then they run with it. And so I think that's similarly what's happening kind of on the credit side. You have some big guys that are doing this, but a lot of it is sort of new opportunities for new people kind of breaking in, or even inside some of these organizations. You kind of saw this on the endowment side, 4 years ago. Like, who was choosing to go into the crypto VC firms? It usually was not the most established person inside the organization. It was somebody more junior inside the organization And what they were doing was saying, hey, this is a direction I could bet my career on, right? Like if I'm the up and coming person, I want to get a promotion inside the organization. Let me take a bet that this industry works. And if it works, then it'll be a new profit center. It'll make a bunch of money. And I've sort of put my stamp on a thing that I advocated. And so inside the organizations, you also see generally, even if it's an established entity, you'll see like the upstart people inside the organization are the ones who are really driving this. So I think it's actually still pretty early days, even on the ETH side, to be able to really borrow against this and do interesting things. And so then when you start talking Sol or Near or AVAX or some of these other things that have DATs or people have talked about, maybe there should be DATs and perhaps there will be in the coming weeks. I think it'll be interesting to see how the credit markets respond there. And I suspect post rate cuts, I suspect that the credit markets will open up. Like I think people will just be more risk on over the next 6 to 12 months. And so as a result, the willingness to lend against these things will go up, and people will sort of move out the risk curve a little bit. So that it's a little bit forward looking in that regard. Is like we don't know exactly yet, but I think my intuition is like there's a lot of money to be made here, and there's a lot of people that would be willing to try to make this a stamp in their career, and so they're willing to do it.
It's another reason that we still have a ways to go in this bull cycle. I want to talk about Ethereum right now and where it is in its evolution, not from an adoption standpoint of the usage of the chain, more from a market adoption, capital market adoption standpoint. Is Ethereum having its Bitcoin moment? And let me phrase what that means. To me, that means, as Tom Lee says, Ethereum is the next Bitcoin. It's the next asset that will be recognized on the level that Ethereum is. And we can talk in a minute about Ethereum as a store of value and the comparison to Bitcoin. But just if you zoom out, is this Ethereum's moment to get to the point where anybody can confidently go to Thanksgiving dinner and say, yeah, buy Bitcoin and buy Ethereum, to your mom who is totally not invest in crypto on a regular basis?
I think it's pretty close. The way we zero index these things, it's hard to compare two things because they started in such different places with different origin stories. But, ETH is just turned 10 in July 2025. And so, we're now in September, right? So you're roughly 2 or 3 months after that. So that's kind of where Bitcoin was. Bitcoin turned 10 in January 2019 because it was started in January 2009. So if you look at it kind of zero indexed, ETH is roughly where Bitcoin would be in like Q1 2019. And I think if you look at the institutional adoption of Bitcoin, like at what point did Paul Tudor Jones and Larry Fink and Stan Druckenmiller, all these people sort of step up and say, wait a second, I think this might actually be a thing. And that transition of going from being a prospective store of value to people saying, no, I think this might actually be a store of value, that transition kind of happened, in my opinion, for Bitcoin between 19 and 24. Like that 4 to 5 year window is where a bunch of people started actually making meaningful allocations in their portfolios to this and started advocating for it for Bitcoin as a store of value. I think that's roughly where ETH is today. Like today, it feels a little crazy to say, hey, this might be a store of value. And I think you're starting to see that same institutionalization happen. I think the big banks, the big asset managers, even the BlackRocks of the world, the people that want to have ETFs, all of these sort of same people are saying, wait a second, maybe history rhymes. Maybe this is the next one. And Wall Street always loves to have a next one. So I think we're roughly where Bitcoin was in 2019. And I think we'll, if it works here, we'll look back in sort of 4 years and say, yeah, 2025-ish, like early 25-ish to, roughly 29-ish, 30 is when ETH sort of stepped into, oh, this is actually a store of value. And Wall Street sat up and said, yes, we'll actually recommend that people get some allocation here. And it makes sense to have allocation for all the aforementioned reasons, right? Stablecoins and DeFi, and Wall Street is building here and yada, yada. Like, I think that the narratives likely start to kick in here over the next, 3 to 5 years.
Why do people invest in real estate? Because it spits off cash flow. But I'm not here to manage rental properties. That's why I'm looking at Figure Markets. Their new democratized prime product backs your money with real cash flowing assets and returns up to 9% APY. It's the first real world asset borrow lend pool built for everyone, not just institutions. Ready to lend like a bank and get more than the 5% Aave is offering you? Download the Figure Markets app today and get 9% on your idle funds. Go to milkroad.com/Figure Markets.
If long meetings and judgmental bankers are your thing, Nexo's probably not. Nexo is a premier wealth platform built for people who value their time and money. It's built for people who have idle cash lying around and want it to grow fast. Whether it's Bitcoin, Ethereum, or even Forex-pegged assets like USDT or USDC, Nexo offers up to 14% annual interest and access to crypto-backed credit in under 24 hours. Your assets need a platform built for growth. Join Nexo.
Do DATs make ETH stronger as a store of value, or do they more push the infrastructure digital oil tagline?
I think more the former. I think it's really, I mean, Tom Lee has done such a great job with BMNR. And generally when you get kind of one that breaks through, you have some sort of typically a power law in these markets. And so it's actually, the bigger Tom's gets, then the bigger Joe Lubin's at SharpLink gets, the bigger, the ETHZilla one gets. And so everybody sort of benefits. But, I think it's actually for the scale that we're talking about now with these DATs, in aggregate north of, I think, $15 billion on the ETH side, it would actually be quite challenging to deploy 15 billion on chain. Like there just aren't enough places to put it yet. And so I think primarily what it ends up being is like a vehicle for the credit markets and the vol traders and retail to be able to say, oh, this is a place where I can get exposure in a differentiated way because at least I get the staking reward at scale and don't have to do it, and potentially could do it in a tax advantaged account. And so I think that's probably the biggest impact in the short term. And then I think as the on-chain stuff matures a little bit, as you get RWAs coming in, as you get new usage on chain, then there's a positive flywheel because now there's a ready source of capital, right? Like there's ETH and dollars that you can borrow against that ETH that can enter on chain and kind of keep the flywheel going now that you have a huge amount of ETH sitting there. So I think it's a necessary component to do the digital oil productive store of value kind of stuff over the next 5 years. And so it's a good thing to exist there. But I don't think the markets can right now absorb 15 billion on chain in sort of a productive way.
It is a very difficult question to answer. What's the end result of this? Is this like a would you rather own ETH or would you rather own silver store of value conversation?
Yeah, that's an excellent question. I mean, that's one we talk about a lot internally, actually. It's funny that you picked that. I don't know if I mentioned that somewhere else and you picked up on it or you independently came to it. But I look at that and I actually think the real long-term comps are, the Wall Street financial markets and what does it mean to have some sort of third space that's not the US financial system and not the Chinese financial system. So what does the world really want, in my opinion, is a dollar denominated financial system where counterparties can make contracts with each other and settle transactions without the US government unilaterally being able to kick them out of that system, right? That's actually, I think, what a lot of the world wants. That's what India wants. That's what actually a lot of people in China would want because they do business overseas. That's what Turkey, Brazil, have you pick. That's actually what people want. But let's set that aside for a second. If you just take the narrow store value commodity sort of lens on it, almost like a Bitcoin lens, even if you say Bitcoin is going to be as big as gold and therefore should be worth north of $1 million and it should be worth north of 20 trillion in market cap, I go down the list of things that are pure commodities that sort of have a lot of these same properties. And I look at something like silver, and silver is north of 2 trillion. And I think to myself, would I rather have 50 kilograms or 100 kilograms of silver, or would I rather just carry some ETH in my pocket and use it productively and convert it to dollars instantly and move it around 24/7 and potentially use it productively? I think on every dimension, ETH is better than silver. And I think markets tend to be rational in this way over time. And so I think a lot of people start to look at this and say, wait a second, do I really want silver exposure? Do I want to have some physical silver? Or would I rather just pick up some ETH? And I think ETH, once it gets into that direction and that trajectory, then I think people say, wait a second, isn't this better than gold? And I think actually there's an argument that just like Bitcoin is superior to gold because it's digital and lets you do certain things that you can't with gold. It's not a pure substitute. I think a lot of people will say you can have both. I think you can look at ETH and say it's also not a substitute for either of those, but it is additive in a lot of ways. And so I think a lot of people will sort of reason through that. We saw this happen, between 16 and 20 on the BTC side. People sort of realized that it wasn't a replacement for gold. It was additive to the portfolio and you should add it in. I think people are now going to go through the same reasoning for Ethereum.
And then do we go further down the crypto stack than that, or does it stop at ETH for store of value?
I suspect it does not stop. I think there's a good analogy here. There's actually some really interesting research I was reading about sort of life on Mars, and they found some certain kinds of deposits, and they're trying to figure out could they have been synthetically produced, and it doesn't appear so. All sort of markers point to just more evidence that there was microbial life. So let's say we come to the conclusion that actually there is life on Mars, and we're able to come to the conclusion that there's no panspermia here. It wasn't like a rock from one planet hit the other planet and it sort of did its thing. It's like a different branch of the life tree, and we're like, wow, this is just a different way to have life, and it's right there. If you have life on two planets right next to each other in the same solar system, I think you have to update your probability, your priors on how much life is there in the universe. Like not necessarily intelligent life, but at least microbial life, because what you have is sort of multiple existence proofs, right? And so the probability just went way up. So I look at something like Bitcoin and say it is so unlikely that the internet would produce something like this, right? It's a purely internet native, memed into existence thing that we took from the internet and backported into the legacy financial systems and the legacy markets and legacy society. That's like a pretty amazing accomplishment actually from the internet, that the internet birthed this. And I think if it happens once, you look at that and you say, well, now I have an existence proof. Like the probability of this happening was basically zero. But the fact that it happened suggests to me that actually the probability of it happening is higher than my intuition might have led me to believe. And if you get a second one, I think you get to a place where you say, wait a second, if it happens twice, the probability has to be way higher that markets just want this for some reason. Now, does that mean there's going to be 100? Probably not, just like in traditional markets. But, I think if you look at traditional market stores of value, you have gold and silver, but you also have fine art, right? We were talking about art before we got on. You have farmland. You have all these different sort of esoteric types of land that you could invest in. You have all these submarkets, like, our Pokemon cards for some group of people, store value. They've actually, if you look at them, from a CAGR perspective over the last 10, 20 years, they've outperformed everything. And so, I don't think these things they're not cannibalistic, right? They sort of build on each other. So I look at that and I say, wow, if you get two, I think you have to update your priors that there's probably way more than two. I don't think you get like 100, but I don't think that's crazy that you get, 5, 6, 7, 10 digital stores of value. And people look around and say, yeah, like I would rather have these properties. I would prefer to have it be guaranteed by math and cryptography and be immutable. I would prefer that it's seizure resistant from the government, that it's 24/7 markets, that I can build on top of it, and it's programmatic and it has APIs and all of these things, right? And for different communities of people, it may make sense to snap to different sort of local versions of this. I'll give you another example. I think if you look at social networks, yes, you have Facebook, which is huge globally, but Twitter can exist or X can exist, right? It has its own sort of unique little community and sort of market dynamics. LinkedIn can exist, and it has its own little sort of quirks. TikTok obviously can exist. Instagram, had Facebook not bought it, is its own thing. And then you start going internationally, right? You have Kakao Talk in East Asia. You have vContacte. You have sort of these regional networks that spin up for various regulatory reasons or for cultural reasons or language reasons. And so you start looking through, Telegram, right, has a different sort of install base. And so you start looking at this and you say, oh, wow, it wasn't actually just one social network that got to 1 billion users. Like you actually had multiple, and they met different needs for different types of people. And actually you can be on LinkedIn, and you can be on Twitter, and you can be on Facebook. Even if one is your primary, you probably have, positions in all of them. You have profiles in all of them. So I think that analogy is kind of similar. Like I think in 2005 or 6 or 7, if you told people that you will manage, 6 messaging apps and you'll have to manage, 8 different social media profiles, but that's just the way the world will work instead of just being one, I think people would have said that doesn't make any sense. Like why would I have 8 social media profiles? But that's what you have to do now, right?
I still feel that way.
Yeah. And so I suspect that that's where these markets end up is, and people forget too, at internet scale, with 5 billion people and 5 billion mobile devices and so on, 500 million is not that much, right? 500 million people doing a thing is not that many people, but 500 million people snapping to, hey, this is a store of value for us, could sustain a $1 trillion market, right? I don't think it's at all crazy. Like I don't think there's 500 million people that own ETH today, right? Or Solana.
No.
And so, I think these markets are quite large, and I think people are really underestimating how big they'll be or how many of such things will exist. And the history of the internet and software and history of markets would suggest that actually there's going to be more than people expect, and they'll be much bigger than people expect.
It always makes me think of a line that Pomp said to me on the show, like a few years ago, which was just looking at age and time. And right now, if you were born 15 years ago, you were born, Bitcoin existed. Yeah. Another 15 years from now, you'll be 30 and Bitcoin existed your entire life. So, I think that everything you're talking about is so relevant. It's the time that we need to get there. And even the DATS conversation we've had recently. We had Andrew Keys and Andreka from the Ether Machine on the show, and they're great. Yeah, and they were both talking about the adoption just being this inevitable curve, right? That it's really just a matter of time right now, that we need more time, and as more time passes, all of these things come to be, because, as you said, they're better forms of money or better forms of store of value, and all the programmability on top of that. I want to shift slightly, because I've got a couple of like kind of more quick hitter questions. I don't know if I would say that necessarily, but I got a couple of things I want to test with you, because I know you've been talking about this recently. You got great takes on this. First, I want to talk about this DeFi after boom that everyone keeps talking about this, that okay, DATs are going to cause this DeFi after boom, right? And you said it earlier that DeFi isn't ready. If there's, let's say, 15 billion ETH in DATs, DeFi is not ready for 15 billion to be moved on chain yet, but they will be. And a lot of that ETH is going to be, that's what all these DATs are going to do. They're going to get yield from their holdings from this ETH. So I have a few questions. First is like, when and how big this will be. Like, is all ETH going to move on chain and be liquid staked and then restaked and then liquid? Like, is it all going to happen? When is it going to happen, and how will it play out?
Yeah. So I want to clarify one thing. I think I should be more precise in my statement. So I think you could certainly put 15 billion into DeFi today. Like, you could park it in Aave, like, the TVL can support it. I think they're certainly, from like a pure technical perspective, like a smart contract perspective, Ethereum can support these assets. And you could stake them or restake them or whatever. The question is, where does the yield come from? And is there an underlying productive use of the capital, so that yield that's flowing through is not just like, hand wavy tokens, like we'll pull it from the future at some point, because that's not sustainable. That is, I think, the missing piece right now. So let's say you did park a bunch of ETH on Aave. Well, who's going to borrow it? And why are they borrowing it? And what rates are they willing to pay you? And is there some fundamental productive use of that stuff? And so I think the missing piece to really have sustainable productive yields on chain is you need actually to be able to move dollars in and out of this system and be able to use them for productive mechanisms. So in effect, what you need is a US dollar capital market to exist here, and to be able to get a variety of assets and exposure for the people that hold those dollars in tokenized form. And then that will create lots and lots of opportunities for people, if only to be able to say, look, I'll deposit my ETH, I'll borrow a bunch of USD, and then I'll go use it productively in these other places. But right now, I think the missing piece is, how do you productively generate yield? That's actually the bottleneck. How long does that take? I don't know, but I think you sort of you're seeing people sprint pretty hard at this. I think like the Etherealized team is sprinting pretty hard at this. Superstate is sprinting hard at this to bring tokenized stuff on chain. You've seen Robinhood saying, hey, we'll bring private equities on chain, like startup equity. You have to imagine Coinbase is thinking about this. So there are a lot of people thinking about this in terms of how to make it real. TBD how long it takes. These things tend to move a little bit more slowly.
But will it happen though?
Absolutely.
Is this?
Yes. Yeah, I think it's inevitable. Yeah.
Right.
And similar to the conversation we're having earlier, like, I think it's entirely possible that for different types of markets, it happens in slightly different places, right? Like, I don't think it all has to happen inside the Robinhood L2. It could happen inside, the Etherealized ecosystem. It could happen on multiple L2s. And you get a bunch of interop that can happen. It could happen, parts of it I suspect will happen on the Solana ecosystem. There may be assets that really benefit from real-time composability or sort of the technical structure there. And sort of the markets on the Solana side are very heavily retail, hence all the meme coin stuff that happens there. And so could there be a bunch of like, could you imagine like all the Pokemon stuff actually happens on Solana, right? Certainly. And I think that's actually like a very productive investment from the last 20 years in terms of compounded growth. So it could actually happen, I think, in multiple places. And it's all kind of happening right now. I mean, this is clearly, there are big parts of the ecosystem, both in terms of number of people and dollars and the foundations and the VCs. Everybody sort of understands that you need capital to be used productively at the end of the day. Like, you can't just give people 15% yield. What needs to happen is a business or a person, some entity on the other side, needs to be receiving funds and be making 20 or 25% on return on equity on that investment in order for you to ultimately be able to make a productive 15%. And so if you don't want this whole thing to be a Ponzi, if you need it to be productive, that's what needs to happen. And enough people realize that. And so I'm almost certain that it happens. Does it happen in a year, or does it happen in 5 years or 10 years is like the big open question right now. I tend to fall somewhere in the middle. I think it'll take a couple of years. I think we may get over our skis on this cycle. And people may say, hey, look, Apollo and BlackRock, you have this like Biddle fund, and Apollo's coming with private credit, and KKR is going to come, and have your pick. But these are very large organizations, and they tend to move slowly, and it takes a couple of years. And so, as is typically the case, I would not be surprised if one of the metas in this cycle is, hey, the institutions are actually here this time, and then people sit up and say, wait a second, but nothing's happening. Right? Like, yeah, well, okay, great. Like BlackRock is here and Apollo's here, and it like doesn't matter. And that, that is when the bottom falls out, where people are like, wait a second, like it's not real. When actually it just takes a couple of years, right? It just takes a while for the organizations to actually shift. And then 3 or 4 years from now, people wake up and they're like, wait a second, this stuff is actually real, So that's just human nature. So I think people will be a little too eager to have this happen in 3 months, and it might take 3 years.
What happens when this does happen, and whether and I completely agree with your thesis on how this likely plays out of the next, the rest of this cycle and the next 4 years. But when this happens and money market funds and money market cash starts to really accept crypto collateralized paper, right? What's the impact of that?
It's a good question. So I'm not deep enough on I'm not a macro guy. So, and so speaking a little out of turn here. Also, I think, obviously this is not financial advice, but I think with a lot of these things, you can be kind of ADIQ about it. If you know the midwit meme, right? Is you don't have to overthink it, and you don't have to be a genius. And it's just, there's a lot of cash in the world, and there's a lot of people that need to put their cash somewhere productively. And even if you look at the 7.5 trillion sitting in money markets in the US, once you go internationally, you realize how big these markets are, right? And so, this is the case for why stablecoin markets are going to be so big. Stablecoin markets will be 5 trillion plus. And I think a lot of those holders are international. They're in Vietnam and Nigeria and Lebanon and Turkey and Brazil and India, places where people want dollars and they can't easily get dollars. And so what happens when that $5 trillion is looking for yield, right? So I think there's a lot of demand in the world for productive financial products. And most of the world outside the US and Western Europe actually doesn't really have access to productive financial products. And so, I think the ADIQ sort of observation here is there's just so much money in the world that doesn't have access to any productive asset, cash flow, that all of that money is hunting for yield. And as all of those dollars move on chain, that it just, there's going to be trillions and trillions of dollars hunting for this stuff. So yeah, I actually don't think you have to like think that deeply about it. It's just like large number times small market share equals like great outcome, sort of startup mentality. Mm-hmm. And if you're directionally right, you're probably underestimating how big it'll be.
Speaking about not thinking that deeply in stablecoins, I want to combine those two together and test the simple stablecoin thesis with you. So there's a simple thesis, which is stablecoins continue to grow, as you said. They're on their way to 5 trillion. That leads to most of that is happening on Ethereum. If you assume that most of that's going to continue to happen on Ethereum, that leads to increased demand for ETH and the need for security using the ETH. That leads to an increased price in ETH, which leads to more institutional adoption. Is the thesis that's just one thesis for Ethereum. Is it that simple? And do you buy into that? What breaks that? What makes that not come true?
Yeah, I basically believe it. I think the flywheel is really simple. People want dollars. Most of the world doesn't have dollars. Once they get dollars, they say, what can I do with these dollars? Oh, I can buy some treasuries. That's great. 4% yield in dollar terms relative to my local fiat being terrible. That's amazing. That's the best financial product I have. And then they start looking around and somebody shows up and say, hey, would you like to make 15% on reinsurance? We're investors in a company called which is a reinsurance company. Phenomenal business. Like, for anybody who looked into the reinsurance industry, just phenomenal businesses. Warren Buffett has made many billions of dollars on reinsurance. And you show up to these people and you're like, hey, would you like to make 15% instead of 4%? And I think a lot of people say, yeah, I would love to do that. This sounds great. And all of that money starts to flow, right? So it's just all of a sudden now you got a protocol and you got retokens and you get a secondary market around reinsurance. And so all of a sudden, you have other people that say, oh, I can offer you this product. And all of a sudden then you need portfolio management tools because you got to like manage all these assets. And here we are, right? We've recreated the financial system, but we've done it in a 24/7 transparent, cryptographic, programmable way. where anybody can participate, any developer can participate, any individual can participate. And so, I think post Genius in the United States, like the stablecoin greenlighting here that's happening, I think that stablecoin flywheel into productive assets, it's just sort of markets are going to do what markets do, and I think the desire for people to make yield on their money is a very, very big driver in the world. So now I think it's just a matter of time. Like I think it's one of these. It's just like in the '90s, could you bet on the internet? Yeah, it's just like it's going to be a thing. And you have to be smart about where you put your money, and you want to blow up, and you don't want to take too much risk, and yada yada. But if you're smart about it, you can sort of take these directional bets, and sort of you don't have to be a genius to say like, oh, all the arrows point in one direction. Let me just sit on that trend.
It comes back to something you said on one of the first, I think the first time we had you on the show. You were talking to somebody who worked in a grocery store, and they were asking about investing, and you said keep it simple, and don't try to get the quick gains. Invest in the simple things, long-term investing, not trading. And it really is that simple, but it's so hard to get out of your own way as an investor. Okay,
the other thing that was a really, I think, interesting insight from that grocery store conversation was how rational that guy was. Like he was not, what you would consider like a typically well-educated, like putting on a suit, working in an office, managing money. But you could see that he could reason through stuff like pretty reasonably. And so, I think a lot of the world, kind of back to this like simple, maybe the takeaway is it's simple but hard, right? It's actually like people want yield, people want to put it in productive places, and they're, you have to be patient to make good investments and let them compound. But actually a lot of the world is willing to do that, right? They're willing to buy every week on the stock market. Like once the meme takes hold and Warren Buffett tells you just like buy a little bit and just hold, and that's like the right way to get rich long term, people figure that out. And I think a lot of the world will do that on chain too. They'll just say, yeah, there's really good stuff, I should just buy the good stuff and hold it and get the yield and make money and stack and compound and not do the crazy stuff because I'm just going to lose money. That's a casino. And over time, like they'll learn that, and then sort of, the market does what it does.
Mm-hmm. Yeah. And you brought up Robinhood earlier in this conversation. And, when Vlad Tenev started Robinhood, nobody thought that the young generation was going to go buy stocks in that way, in the way that he showed that, oh, wow, they do want to do this. And we just need simpler, easier ways for the world to do that. So I think you're right. There is, and that's where fintech colliding with crypto right now is a massive adoption cycle that is going to be caused on that side too.
Yeah. I mean, I think fintech and crypto are now one and the same. Like crypto is just the back end for fintech. Yeah. These things have completely converged. Like there's no reason to even think of these things as separate categories, in my opinion.
I like that take. I really like that take. It's funny. It's so obvious, but nobody's saying that yet. Yeah. Okay, last question. I asked our community what they wanted me to ask you today, and not financial advice, but they said ask him how to invest in DATs. And let me phrase that. Let me contextualize this for you. We've had a lot of community members, and I talk to retail investors every day that have not done well with investing in DATs so far, because they're very volatile. They're difficult to understand, the way the unlocks works, the way they're raising capital, all of these things. Unless you're a financial marketing expert, those things are difficult for retail to understand. So let me ask you this: what's the playbook that could work for retail?
It's really tough. The reason it's really tough is that there is a lot of financial engineering going on, and so I actually think most retail probably should not be touching these stats unless you really understand, like what a pipe is, or how leverage works, or how convertible debt works, and you're able to parse, an 8K, or you're able to parse some of these SEC statements to understand like what exactly is happening. And so you see this challenge actually even on some of these like dashboards where people will talk about, here's the MNAV for these instruments. Sometimes those are wrong because the person that's reading the thing doesn't understand that some amount of debt is encumbered, so you can't actually count it towards like the market cap value of the company. It's actually going to convert into shares. And so like even the dashboards are having a tough time keeping up with this. So I think it's very risky. I think the way to think about it is, one, you want to pay attention to the MNAV. And if the MNAV is significantly above 1, you're taking a lot of risk. You're taking a lot of risk because markets tend to be efficient. And I think many of these things converge towards something closer to a 1x MNAV rather than closer to a 2x MNAV in time. I could be wrong on that. So not financial advice, obviously. But I think that's where a lot of people have gotten burned, where these things are trading at, you have 500 million of ETH on the books, but you're trading at $2 billion market cap. And so the market can be irrational. There's share float issues and illiquidity issues. There's all sorts of sort of complexity here. So I think by and large, people should probably be careful and probably should avoid this and let kind of DAT mania die off a little bit, just like there was SPAC mania. You're dealing with a very high risk, high volatility sort of moment. But I think there will come a time where, from a thoughtful investor's perspective, some of these things will be very compelling, and that might take 6 or 12 months, right? It might take 6 months for the MNAVs to collapse back closer to 1. It might take 12 months for the good managers of these assets to emerge, and so you see some dispersion. You start to see these guys really know what they're doing, and those guys don't, and so the guys that don't get consolidated up, and so you kind of have to let that play out a little bit and be patient. And so my sort of advice would be, most people actually probably should not be doing this. The people that are, make sure you actually understand what you're investing in. If you understand it, there are some opportunities there, because there are things that are trading below MNAV. There are things that are mispriced in the market. There are microcap things that are illiquid that actually, if you buy into, once the market figures out that it's actually a really good management team, those things probably do really well. You get some sort of levered ETH kind of exposure if that's what you're looking for. But these are all pretty sophisticated financial tools that most people are very wary of.
I had a feeling you were going to say that. I had a feeling you were going to say that, which actually perfectly sets me up to say, if you want help understanding these things, you should subscribe to Milk Road Pro, because at Milk Road Pro, we break down DATs and MNAVs for you guys on a regular basis. We've been putting out a bunch of reports about it. So check out Milk Road Pro. I had to do the show. I had to take the opportunity. And then I think, Avichal, your point though is very well taken. DATs can be a great investment, but it's difficult. So be very careful. And the time to invest in them might not be now. It might be during the next bear market, when you can pick them up at a cheaper rate, and when they've had some time to get through this mania that they're in right now, and they've settled, and we actually have an outlook that makes sense. So Be careful out there, everybody. And if you are investing in DATs and you want to now, check out Milk Road Pro. Avichal, great to have you back on the show. Thanks for the time.
Great to see you. Thanks for the time.
As always, remind you guys, not today's episode of financial advice. Thanks for tuning in, everybody. If you're swapping, make sure you check out Milk Road Swap, swap.milkroad.com. Best fees in the space, what I use to swap. Have yourselves a wicked awesome day. We'll see you back again tomorrow. Want insights on what's moving crypto markets and how we're trading each event? Subscribe to our channel and join the Milk Road Daily and Pro newsletters and start investing like the top 1%. This show is for educational purposes only. Nothing we say is financial advice. Investing is risky. Never invest more than you can afford to lose.